So Andy, how can business owners use pensions to reduce their taxes?
We're specifically talking about limited company directors.
Yeah.
Yeah. Okay. So it's a brilliant tool for directors. Essentially, when you run a company, you've got the money which comes into the company, which is a turnover, and you can deduct your business expenses, costs, travel, stationery, whatever it might be. And then you're left with what is your net profit, which is what you have to pay corporation tax on. So a director pension contribution, whether it's a regular or a lump sum, is a business cost. So the effect is it's going to increase your business costs, which are going to reduce your corporation tax. So by making a director pension contribution, you're going to save yourself 25% corporation tax, which is fantastic news.
Yeah.
Now, my clients who are company directors, what we tend to do is set up a regular contribution on a monthly basis, depending on what they can and can't afford. And then at the end of their business year, we look at what the situation is in the company, a conversation with the accountant, how much money is available to make a lump sum at the end of the business year as well. The result for them is a huge corporation tax saving. They're getting money out of the company into their own name without paying tax. Ordinarily, if you want to take money out of your company, you've got to pay salary or dividends, which are not great from a tax point of view. And they're building a pot of money in their own name, which is growing tax-free.
Okay. Are there limits?
There are limits, yeah. So the basic rule is a company director can do £60,000 per tax year. However, if they've not contributed for the 3 previous tax years and they've already got a pension scheme open in the UK, they can actually carry forward unused allowance from the 3 previous tax years.
Right.
So the last 3 tax years, inclusive of the current, is 60,000, year before 40,000. Now, the only caveat around that is it has to satisfy the wholly and exclusively for the business of trade test, which is a conversation to be had with the accountant.
So Andy, a lot of people ask me if they're self-employed, sole trader, and they want to put money into pensions, how do they go about claiming the tax relief in the same way that someone who is an employee would?
Okay, so it works very similar to how it would do in an employed role. So effectively, if the individual is a basic rate taxpayer, how it would work is they'd put a lump sum or regular contribution into a personal pension plan. The government would instantly add 20% tax relief to the contribution, and that is the amount which is invested in the pension.
So they don't need to do anything?
No, not for the basic rate tax relief. No, that's all sorted. Right. Now, if that individual happens to be a higher rate taxpayer, when they go through their self-assessment, presumably with their accountant, when they're doing their business returns, the accountant should note what their pension contributions are. So how this works is when the tax bill comes in the following January, the income tax liability will be less. That's how it works for them.
All right. Okay. That's good. That's good to know.